Welcome to this explainer. We're going to dive right in and demystify the somewhat complex world of commercial equipment financing in Canada, essentially handing you the insider's playbook. Look, if you're a business owner trying to scale, you already know that having the right tools is absolutely non-negotiable. But let's be real, navigating the funding landscape can sometimes feel like tiptoeing through a minefield of fine print. Well, today, we're going to clear that path for you.
Okay, picture this. Imagine you desperately need a major piece of machinery to grow your business. Let's say a brand new $250,000 excavator. But dropping $250,000 in cold hard cash just isn't happening. Or maybe you do have the cash, but sinking it all into a single asset would leave your business totally vulnerable. So how do you get that equipment onto your job site by next week without completely wrecking your company's financial safety net?
To answer that, we're going to break this down into 5 quick chapters. First, the equipment funding dilemma. Then, loans versus leases explained. Next, decoding rates and hidden fees. After that, matching files to lenders. And finally, smart shopping and government aid. Let's get right into it.
Section 1. The equipment funding dilemma. This is the immediate pain point virtually every owner-operator faces when it's time to scale up.
Obviously, heavy machinery, trucks, and specialized gear are prohibitively expensive to buy outright. But by leveraging the right financing strategy, you can keep your liquid assets free for the everyday stuff, payroll, fuel, materials. Essentially, you're using the revenue generated by that new equipment to actually pay for the equipment itself over time. That right there is the core philosophy of smart business growth.
All right, Section 2, Loans versus Leases explained.
This foundational difference is so crucial to grasp. It really comes down to ownership versus usage. With a standard loan, you borrow the money, you buy it, and you own that asset from day one. Come tax time, you recover your costs through interest deductions and the capital cost allowance, the CCA, for depreciation. A lease, though? Totally different story. The lender actually owns the asset, and you're just paying for the right to use it. The upside here is that this often lets you deduct the entire rental payment as a business expense in the year you pay it. So which one is better? It honestly depends entirely on your specific tax situation.
Now, leases generally come in 2 different flavors here in Canada. First, you've got the capital lease. This acts a whole lot like a loan because you're paying off almost the entire value of the machine, which is why these usually end with a symbolic $1 buyout. You basically own it at the end. On the flip side, an operating lease gives you the absolute lowest monthly payment. Why? Because you are only financing the depreciation of the equipment during that specific term. The lender takes on the residual value risk, and at the end, you can either just walk away or buy it for fair market value.
But here's the catch, and it's a big one. How does Revenue Canada view your agreement? This isn't just splitting hairs, it completely dictates how you file your taxes. For example, if your lease agreement states you automatically get the title at the end, or if it gives you a massively discounted purchase option that literally anyone would take, Revenue Canada might look at that and say, hold on, that's not a lease, that's a sale.
Interestingly, though, a note from the Canada Customs and Revenue Agency clarifies their stance. A lease is actually judged by the legal relationship established in the text of the agreement itself, not necessarily an attempt to figure out the underlying economic reality. The big takeaway for us? Always have your accountant review the legal structure of your lease agreement before you sign anything. Nobody likes tax time surprises.
Moving on to Section 3, decoding rates and hidden fees. Let's pull back the curtain on how lenders actually price your risk and, more importantly, how they hide their costs.
This is literally where so many folks get tripped up. Do not fall for the lowest headline number. The stated rate is just the baseline percentage applied to your balance, but the APR, the annual percentage rate, that's the true cost of borrowing. Think about it. An 8.5% stated rate with heavy upfront fees could actually end up costing you way more over 5 years than a 9.25% stated rate with 0 fees. When you're comparing offers side by side, the APR is the only number that really matters.
Lenders are super creative when it comes to making their interest rates look incredibly low, so you've got to watch out for this specific list of hidden fees that sneak into your final contract. You might see documentation fees anywhere from $250 to $1,500, appraisal fees for used gear, or even massive prepayment penalties. Seriously, if you plan to pay off your loan early because you landed a huge contract, a 1 to 3% prepayment penalty is a huge hit. You absolutely have to ask about these up front.
Check out this breakdown. Notice how your credit score directly drops you into these national interest rate ranges. Depending on current benchmarks, rates can be anywhere from 6.5% if you have excellent credit, all the way up to 22% if you're rebuilding. Your score sets the general ballpark, but things like the age of the equipment and your business history will adjust exactly where you land within that tier.
All right, Section 4, matching files to lenders. Knowing your rate range is great, but it's only half the battle. Next, you have to match your specific file to the right lender.
Because look, applying at the wrong tier can actually ding your credit score with hard pulls. Big banks are fantastic for the lowest rates, but they strictly want perfect credit, brand new machines, and they usually take weeks to say yes. Captive finance, think Cat or John Deere, are amazing for new dealer promos. Equipment finance companies sit right in the sweet spot for mid-tier credit and used equipment. And private lenders? They're basically your emergency tool for older machines or challenge credit, especially when you need cash fast.
And you know what? Chasing the absolute lowest rate isn't always the smartest move. Seriously. Sometimes paying a higher rate to a private lender makes perfect sense if it means getting a machine on your site in 5 days to secure a super lucrative contract. If you wait 5 weeks for a bank's slightly lower rate, you might lose the job altogether. The profit you make from starting on time can easily wipe out that slight difference in interest.
Finally, Section 5, Smart Shopping and Government Aid. We're going to walk through how to shop these rates safely and look at a massive government program built specifically for businesses like yours.
To shop around without wrecking your credit, you need to follow this exact 3-step process to ensure you're comparing apples to apples. First, pull your own credit. That's a soft pull. It won't hurt your score. Second, get at least 3 quotes, and ideally do this within a 2-week window so the credit bureaus treat it as rate shopping. Third, calculate the true total cost. Simply add up every single payment and fee over the life of the term, subtract the principal, and compare that final dollar amount.
Now, if you're hitting a wall getting traditional approval, I want you to burn this number into your brain, $1.15 million. The Canadian government actively shares the risk with lenders through the Canada Small Business Financing Program, offering a maximum total loan amount of up to $1.15 million.
If your startup or small business pulls in $10 million or less in gross revenue, this program is absolutely for you. It lets you secure up to $500,000 specifically to buy or improve new or used equipment. Because the government backs the risk, the bank is way more likely to say yes. Just keep in mind, the lenders still set the rates, usually capped around prime plus 3%, and unfortunately it cannot be used for farming businesses since they have their own separate programs.
Wow, we have covered a lot of ground in this explainer. But now that you've got the insider playbook to navigate loans, leases, credit tiers, and all those sneaky hidden fees, you are fully equipped to make decisions that will protect your cash flow. So the only question left to ask yourself is, what will your next big equipment investment be? And how are you going to fuel the next stage of your business growth? Thanks so much for tuning in, and I'll catch you in the next one.